Good afternoon, everybody. I'm joined by Joe Vaclavik of Standard Grain. Joe is going to be talking to us about the agriculture market. How's it going, Joe?
Pretty good.
So it's been a very interesting time right now in the ag market. We've got some depressed levels here in soy, corn that we were just talking about, and we just yesterday had a big deal with NAFTA and also the Farm Bill. So I wanted to get to those points. So what are your thoughts right now in the general market?
The markets are in bad shape. I mean, the corn market's soft, the soybean market's soft, the wheat market's soft. Some of the things going on in the cash market, which is separate from the futures market, are really, really bad. The basis is something that we track in working with farmers and end users also. The basis is the difference between cash and futures. And the basis levels for soybeans especially are some of the worst that I've ever seen. Interior basis levels, at your local elevators and processors, river terminals, the PNW, there's just no real market to be found, the Gulf. And we deal in markets that are settled to a physical commodity. So we've got a situation here where the futures may be overvalued, especially in beans relative to cash at this point.
So that's interesting. So take us through what that actually means, the basis differential, and how you get that opinion, just for somebody who doesn't know.
Okay, so November soybeans are $8.36. That's not what the farmer gets for it when he delivers it. What the farmer gets is the cash price. So the cash price is the futures price, and then they subtract a basis. And a normal basis for, say, like, anywhere in the Corn Belt might be anywhere from 20 cents under down to maybe 30, 40 cents under. We've got basis levels in some areas of the country that are more than $1 underneath the futures. There are some places in North Dakota where cash soybeans are under $7 a bushel, and that compares to a futures price of $8.36 for November. So the spread there between the cash market and the futures market is very, very wide, and that's seen as being a negative factor. You're usually going to see some convergence between the cash and the futures come delivery, and we're going to get into a delivery here in the September futures soon, and it's something that's viewed as being kind of a negative for the futures market, I guess.
Yeah, absolutely. So how can somebody track the actual cash market, like you said, at different parts of the country?
There's a number of different websites where you can, if you go to Google and punch in, soybean basis levels, you'll probably find a couple of websites where you could punch in different zip codes, and it's different everywhere is the thing. And the whole country uses the futures market as a way to track, prices, but every elevator, processor, end user has their own cash price that they make. So, if you've got like a premium newswire service, like I've got the Reuters service, I can see, cash prices at 1,000 something different locations. But in general, there are some simpler alternatives to be able to track basis.
So that's pretty interesting. So based on what you're seeing on the basis being significantly below, I'm sorry, the cash price being significantly below, that it doesn't seem like there's much relief in terms of these soybean prices, which, as we're commenting, we're basically on the low level of the year. SEP beans are right now at 822. They're down about 1.5% on the day. I know you were taking a look at Novi beans before, which actually just brought up a chart. It looks like we got down to 825 a few weeks ago, and Novi beans are right now at 835.
Yeah, that's a big low. Those are big technical targets. And the November soybeans at 825 or 826. D's corn, that 350 is where we bottomed out in July. So those are your most logical downside targets here. We're really within a bearish seasonal time frame in these corn and soybean markets. As harvest approaches, the markets generally push lower, especially in years when you've got big crops expected, and that's what we've got this year. We've got estimates for a record corn yield and for a record soybean yield. So when you've got big crops and you've got substantial or adequate old crop inventories, inventories of last year's crops still sitting around, it's very, very normal for these markets, corn and soybeans, to leak lower into, say, the first week in October. If you average it out over the last 30 years, your harvest low, as we put it in our industry, generally occurs right around October 1st. That would be an average.
So what's it going to take to change the downtrend in soybeans to get prices back up to $9, $10, $11? Is it something out of China, out of the U.S. administration, or is it just the fact, like you're saying, it's just a massive supply right now?
China would be the first thing on the top of my head. I mean, if we were to announce tomorrow that we've got to deal with China, I believe the soybean market would rally drastically. I also believe at the same time that the effects of this tariff situation on the bean market have been greatly exaggerated. I mean, it's made an impact on the market, no doubt about it. I mean, the Chinese issues, or this China trade war is certainly responsible for a portion of the losses here, and it is going to reduce demand. But we've got other factors at play here too, which I think are equally as bearish. We've just been overproducing this stuff. I mean, we've been planting more and more acres of beans here in the U.S. We've been yielding really well. We've gone years without any sort of real yield problem or production problem here in the U.S. The same thing can be said globally. You know, they expand soybean acreage in South America every single year. They're going to do it again this year. The currency issue is a problem. The South American currencies have really just fallen apart versus the U.S. dollar,
Yep.
which is a problem. So there are other factors at play here beside China. I mean, you read the news and you would think that all of this $2 break can be attributed to China, and that's just not the case.
Yeah.
In my opinion, anyways.
No, that makes sense based on everything that you're saying there. It's interesting. On Mondays, we have Adam Collins of Movement Capital discussing the latest COT report and seasonality. And it's really interesting. He's pointed out for the last few weeks how spec longs in wheat have been significant, up in the like 90 percentile. And it's interesting looking at the chart. We've had a significant fall in wheat, from well above 600 to here we are at 524. And, any thoughts on the wheat market?
Yeah. So first off, the way that the funds are positioned in the grain complex right now is totally backward relative to what we've become accustomed to over the last 10 years or so. I would say that a normal fund positioning in the grain markets would be very heavily short wheat, maybe long soybeans, and they could be either side on the corn market. We've got a situation right now where funds are heavily long wheat, although they've reduced quite a bit of that here recently. They're heavily long wheat, and they are modestly short corn and modestly short soybeans. That's not a normal position relative to what we've become accustomed to. The wheat's got a fundamental story, potentially. We've had global production issues all over the place. I mean, major producers like Australia, the EU, Russia, Ukraine, I mean, the Black Sea region, even the U.S. here this year, we've had production problems. What it comes down to is this: we do not have an export market for U.S. wheat, and it's been a chronic problem for years and years and years. And a lot of it lies in this what the CME refers to as a variable storage rate. And essentially, what they've done is they've incentivized commercial grain outfits, elevators, to store wheat rather than sell it. They can make money simply by storing the stuff and carrying it from month to month, and that's enough for them to make money. It's really taken the incentive away to export a whole lot of wheat. So, wheat could have a story if we could start exporting the stuff. The problem is that we just can't. So I fear that if the row crop markets, corn and soybeans, continue to leak lower, you may see more of the same in the wheat market.
Yeah. What about yesterday? We obviously had the NAFTA, which the NAFTA or change, no longer called NAFTA, but the deal with Mexico, and then also passed was also a farm bill helping subsidize farmers. Tell me more about that and how that's going to affect things.
Well, so the government's going to provide direct payments to farmers, essentially, to account for what they have determined has been the impact of these tariffs. There are a lot of details here which make this thing not necessarily as good as it sounds when you look at the headlines. They're going to make payments based on actual 2018 production of grains and some dairy products and some livestock products, basically on a basis of production. The payments are going to be made initially only on 50% of production. So if you grow 100,000 bushels of soybeans, you're only going to get paid on half of that. They may initiate payments on the second 50% of production in December if it's deemed necessary. The big beneficiary here will be the soybean grower. It's $1.65 per bushel. That's a lot when you consider the board price is $8.37. One of the big things that's going to come into play here is that they're going to cap these payments. An individual entity can only receive $125,000
Right.
for grain. I mean, I've got producers who, if it weren't for the cap, might be eligible for $500,000 or for $1 million, and they're not going to get that. Also, if you have an adjusted gross income above 900,000, they average it out over the last 3 years, you're not eligible. So there's going to be a lot of bigger outfits that are not going to benefit from this. It'll certainly benefit some of the smaller to mid-level producers, but some of these caps and restrictions, they make this program not as good as maybe what we thought it could have been.
Yeah, that's
just for the farmer. And I'm not saying that it's a good thing overall. I think the vast majority of farmers would rather have a free trade system and not have to deal with government handouts. I think that's probably the thought among many farmers. But this helps. I guess it's a Band-Aid, but it's not a fix.
Right. Well, that's it sounds like a bit of a Band-Aid. It's some relief, but a lot of people are also not satisfied, I guess.
Right.
And then, what else is on the radar? So when you look at the markets, we've kind of gone over soy, but coming into the end of August, what do we have in terms of reports over the coming weeks that can really be a big catalyst?
Well, the USDA is going to update its yield estimates for corn and soybeans on September 12th, I believe. That's going to be our next big data point, would be the government numbers. And it's really not till September or October that the government becomes more accurate with their yield numbers relative to the final numbers. The August numbers is a starting point, and they do become more accurate relative to the final January numbers in September and more so in October. So that's going to be our next big data point here. The other thing to watch, is just going to be news. If we could get something going on this China front, it would really go a long way, I believe, into prices. I think you've got a longer term, maybe friendly story in the corn market. We are going to use more corn than we produce this year. And we're going to see our ending stocks, our supplies here drawn down by a good 20% in the United States. And it's a similar statistic globally. So I think you got a story there, but I think it might just be the wrong time of year. We got a big crop coming, and we've got some old crop supplies to chew through. But once we get past harvest and we get toward the later part of this year into the early part of 2019, I think you could have a nice upside story in the corn market. I really do.
Yeah, that's interesting. So you're saying that demand is going to outpace supply this year?
Yes, we are going to, I don't have the numbers in front of me, but I think total usage will be 300 to 400 million bushels above total production. So we're going to see our ending stocks draw down, and the way you calculate a carry out is you've got to take your beginning stocks, which is your carry out from last year, and then tack them onto the balance sheet. So we're still going to end up at the end of the 18-19 marketing year, which ends about a year from now. We're still going to have quite a bit of corn around. We're going to draw down those stocks quite a bit year over year.
Interesting. All right. Well, Joe, thanks a lot for the information. We'll definitely keep a close eye on those next key reports that you're talking about. Hopefully we'll have you on before that to go over, what the market might be looking for and some interesting price levels, things of that nature. But thanks for taking the time as always, and we'll speak to you soon.
That sounds good. Everyone have a great week.
All right. Thanks, Joe.